Hello, Marc from ADM Investor Services International. With the Brexit deadlines, or the ones which are very much movable feast deadlines, looming, I thought it might be an idea just to have a quick look this week at how the UK currency, the pound, has done, and how the various asset classes have done in very broad terms as we approach those deadlines. So my first chart is a comparison of the UK 10-year yield versus the US 10-year yield over the past 5 years. Notable for the fact that obviously it includes all the shenanigans after the referendum, but really telling us a story of incredible stability. Basically, UK yields have tracked the US ones, but in a much less volatile fashion and in a much narrower range than the US. So quite remarkable, fairly impervious to Brexit, one would say. The second chart today is to compare the FTSE 100, which of course is not really a good barometer for the UK economy because it's so full of dollar earners and a lot of mining and energy, large cap mining and energy companies, and compare that with the FTSE 250 or the FTSE, the mid cap, just to sort of see if there's any real divergence going on there. Well, first of all, it is obviously, this is only over the past year, I should add. First of all, it's noticeable that basically they have been largely tracking each other. But when there is a little bit of optimism around, as there was at the beginning of the year and just recently, though I would make a distinction on that outperformance of the FTSE 250, which is the better barometer for the performance of UK PLC, as it's known. So it's clearly underperformed most other markets. The US has been busy making new highs. The FTSE, both the 250 and the 100, are still well below the levels that we reached back in January, February. So moving on, given that there's been a clear underperformance in the stock indices, what about the currency? So the last three charts are all related to the currency. The first one is sterling dollar, or cable. As one can see, basically, actually, it's been in a very broad range of 115 to 140, and mostly in a 125, 135 range for the bulk of the past 3 years. Occasional spikes here and there, though the one back in early 2020 is not really related to anything to do with Brexit. So that's probably more a function, really, of what's been happening with the dollar. So probably the better barometer of sentiment towards the pound is indeed the euro-sterling rate. But again here, yes, the pound lost a lot of ground back in 2016, immediately post the referendum. But the range that's been in place since then has actually been, relatively speaking, quite tight. And as much as there are clearly, we are starting to factor in that the idea that there's not going to be a trade deal for the end of the year, it's not necessarily exactly falling out of bed here. I think the interesting aspect is how we are pricing for the volatility, for the likely volatility, depending on the outcomes. And that's interesting in terms of the volatility that we've seen in sterling euro. And this is my final chart, which is the 30 and 90-day volatility measures. I think the first thing to note, obviously, is the volatility was much greater in reaction to the COVID transmission than anything else. And that's probably a good note to conclude on in respect of Brexit. Brexit is clearly going to be important to the UK economy. But given the fight against the pandemic and the economic scarring that there is going to be from it, not only in the UK, but around the world, it is probably subsidiary to Brexit, but it certainly makes Brexit an extra complication that perhaps the UK could do without, but will put it perhaps at a disadvantage depending on the outcome of the trade negotiations. Those are the thoughts for this week.